Let's get started with the first conversation today. If I have one wish for you in 2022, it is that you should amass a large amount of capital gains. And while that's good news for both yourself as well as your portfolio, your government will also be very happy as long as you book out those capital gains at some time, because what happens then is that you have to pay capital gains tax, and that's beneficial to the country at large. But we'll focus on capital gains, we'll focus on capital losses, how to contend with both of those, and how to manage your taxes on an ongoing basis. Joining me to talk about all of this and more is Arvind Rao, who is a chartered accountant, certified financial planner, and the founder of Arvind Rao Associates. Arvind, thanks as always for joining in. Now, of course, there are various asset classes, so perhaps just to set the ball rolling, perhaps we can talk about the major two asset classes: fixed income, and that is debt mutual funds, and equity, and how capital gains tax is calculated in both of those.
Sure. So, Alex, for debt, it's pretty simple that in case there is a short-term capital gain across these debt categories of mutual funds, all the gains are taxable as per slab rates applicable to the taxpayer. And in case of long-term gains, it is taxed at 20%. The difference here being that while calculating these capital gains, the indexation due to cost inflation is allowed while calculating the long-term capital gains. This is as regards the debt side of it. Coming to equities, broadly, if you are having short-term gains that are being earned on listed equity shares or even equity mutual funds, in that case, the short-term gain tax rate is 15%. And on the other hand, if there are long-term capital gains on equities, then the same is taxed at 10%. But the difference here as compared to the debt is that no indexation of cost is allowed. That's, I think, the major difference that our viewers need to note here.
And the threshold, right? I was covering the budget when former Finance Minister Arun Jaitley announced the reintroduction of long-term capital gains on equity, and there was a sharp intake of breath at that time, because I don't think that the market ever anticipated that this would be reintroduced. But now that it is there is also perhaps the newer investors won't know about this, but then they can talk to their parents who have invested starting in 2010 and before that. There is also grandfathering to bear in mind, right? So can you also explain that, Arvind?
Sure. So like you rightly mentioned, the day the budget was tabled was actually 1st of Feb. And when they talked about reintroducing the long-term capital gains, obviously they wanted to make it a prospective taxation and not a retrospective one, because of which the whole grandfathering concept now is that all the long-term capital gains earned on listed equity shares or equity mutual funds till 31st of Jan 2018 is exempt, and a taxpayer is only required to pay tax on gains that have been earned from 1st of Feb 2018 onwards. But one more thing I'd like to highlight here is that the way the grandfathering works is that you are allowed to take your cost, while calculating the capital gains, your cost has to be taken as the actual cost that you might have paid to buy these shares or funds, or compare it with the highest price or the closing NAV of the shares and the funds as on the 31st of Jan 18, whichever is higher, that's what you have to take. But our viewers need to take note here that the whole concept of grandfathering is to restrict the capital gain taxation on gains made subsequent to 31st Jan. By virtue of comparing the high prices and the cost, one cannot claim a loss on account of grandfathering. So I think that is something people need to keep in mind. Other thing noteworthy to be mentioned here is that because this was a new tax and the budget didn't mean to have this tax cause a big hole for small investors. So all long-term capital gains on listed shares and equity funds are exempt up to a threshold of 1 lakh. The interesting bit here is that unlike this threshold works very similar to the income tax slabs. By which I mean is that suppose you earn 3 lakhs of long-term capital gains in a year, it's not that the entire 3 lakh is taxable. From this 3, you can reduce 1 lakh of the threshold and only the balance 2 lakh is taxable. So this 1 lakh is basically like an exempt long-term capital gains for all kinds of investors.
That's very well explained, I would say. But there are also some nuances with regard to the charge of tax on equity, and this is something that I think has been a point of consideration, a point of discussion in several fora. Arvind, the levy of securities transaction tax on individual stock purchases. Could you explain how that works?
So going back to history, like you mentioned, 2008, if I recollect it right, was the year in which long-term capital gains were made exempt from tax, because that marks the year in which the security transaction tax was introduced. So the logic here was that you pay a transaction tax on every trade that you make, and thereby I think the capital gains need not be computed and offered to tax. That was the whole principle. But as years have passed, the STT has got well accepted, and I think the STT collections are pretty robust. But in 2018, when the capital gains got reintroduced, the STT remains. So on each buy or sell transaction, or basically on any trade that an investor does on the exchange, or even does any redemption, or mainly redemption in case of mutual funds, there is an STT that is paid. In case of equity, it's around 0.1% of the value. So this is the transaction tax paid, and capital gains is over and above this.
Okay. There is also a threshold in terms of the income overall. If it is less than 2.5 lakhs, how does that work, Arvind?
This is an interesting point. And as we saw that most of these long-term capital gains and sometimes even the short-term or let me put it the other way, short-term capital gains for equities as well as the long-term capital gains, they enjoy a flat rate of 15% and 10%, as well as these the long-term capital gains for the debt mutual funds, as I mentioned earlier, has a flat rate of 20%. Normally, when incomes are chargeable at a special rate or a flat rate, as we say, these rates are as I say it, I'm so sorry. These rates are independent of the slab at which the investor, the taxpayer is supposed to pay the taxes. However, the differentiation here is that for resident individuals and even HUFs, if they are having short or long-term capital gains, and that is the only source of income for them, and point number 2, if these gains are less than 2.5 lakh of rupees, which, let me reiterate, 2.5 lakh is the maximum amount of income which is not chargeable to tax for any taxpayer. So as long as your gains are within this bracket of 2.5 lakh, although there is a flat rate of tax, the taxpayer need not pay any tax on it, because it is within the limit of income which is not chargeable to tax.
Interesting. Now, there is also a provision, and this is interesting because I don't think enough attention is given to it. Perhaps in conversations with CAs like yourself, there is a little bit of surprise saying, oh, thank goodness I don't have to pay this much tax. And that's because sometimes you have to book out losses. How does adjusting work? You can set off losses that you make in a particular year for gains made in another year, how long can you carry forward that loss?
This is, and Alex, I like the way you mentioned this, because um, this is exactly like a conversation which had happened with the client. I think this was around end of last year. People are so used to, or it is so much drilled in people's mind that you have to pay tax on any income that you earn. So whenever they have been booking profits, whether it is in case of shares or funds, it keeps riling in people's mind that I have to pay tax on this. And any losses that they make, it's always assumed that it's a loss, I can't do anything about it. So whereas of course logic says that since it is net profit, so you are allowed to offset the losses that you incur in case of trading in or selling in shares or funds against the profits that you make, and only the net gain is liable to tax. So in case in this process of netting off, which by which I mean the losses earned are more than the profits earned, what you get as a net result is a loss. Now, things when it comes to setting off losses is not very simple. So let me just divide this, saying that I think most of us are aware that losses can be either short-term losses or long-term losses. The tax provisions say that short-term losses can be offset against short-term gains, and you can also offset your short-term losses against your long-term gains. But the reverse is not true, which means if you have long-term losses, those can definitely be set off against long-term gains. But can you set off your long-term loss against short-term gains? The answer is no. So ST, short-term loss, works well for offset between short-term gains and long-term gains. But when it comes to long-term loss, it is strictly allowed to be set off only against long-term gains. Now, let's also look at a scenario that in a particular year, I may not have that much amount of short-term gains which are sufficient to absorb the short-term losses that I may have incurred. What it means is that at the end of the year, I have some short-term losses and I don't have any short-term gain or long-term gain against which I can set this off. So what happens next? It's very simple. You are allowed to carry forward these losses. When you carry this forward, you are allowed to not only carry it forward, but you're also allowed to set it off against same rule. If you're carrying forward short-term loss, you can set it off against short-term gains in the next year or in any subsequent year, as well as short-term loss, brought forward short-term losses can be offset against long-term capital gains in the next or the subsequent years. However, long-term losses that you carry forward can be offset only against long-term gains in the subsequent or the next years. What is the time period for which you can carry forward these losses? As we speak, this time period is 8 years. That means the year in which you incur the loss, once you carry it forward, you are allowed to use this loss to be offset against the gains made in the subsequent years up to 8 years. What happens if you don't have any gains in the 8 years? Then in the 9th year, these losses will just, they will lapse. You can do nothing about it. Another thing here is that when you are carrying forward losses and setting it off against gains in the subsequent years, as a taxpayer, you don't have a choice. Meaning, Alex, if you remember, sometime back we took an example where we said that that in the next year, let's assume the taxpayer has only gains of 2 lakhs, short-term gains of 2 lakhs, and there is no other income. So virtually, you have a brought forward loss of, let's say, 1 lakh, and in this year you make gains of 2 lakh. Now, logic says you are supposed to offset this, but the taxpayer says that I don't want to offset it in this year because anyways, I am below the threshold limit of income tax. So let me not offset it and I will carry forward this loss for the next year where I have more income, then maybe I will offset it. So this choice doesn't exist with the taxpayer. irrespective of the income level, once you carry forward a loss, it has to be set off against gains as and when they keep being made in the subsequent years. I hope this is quite clear, Alex.
No, it is very clear, and that is in fact. I also understand, Arvind, that you can utilize this, and of course, it only becomes a capital gain or a capital loss if you actually go out and book either a profit or a loss. If you don't, obviously, it remains a notional loss or a notional gain. So, how does one use these thresholds and the ability to carry forward losses in a smart and efficient way?
So this is something, and I'm happy you brought it up, because this is something which typically happens in the month of Feb and March. So let's take my example. I'm holding a particular share, and I'm very optimistic about this share, and I'm actually holding it for the long term. Now, I have bought it maybe 14 months back, and in the month of Feb 22, when I look at it, I see that it has already showing me gains of around 80,000 rupees. And I'm relaxed about it. I want to keep on holding this stock for a longer term. Now, here's what we can do of utilizing the threshold available. What I should be doing is, come Feb, I should be booking this notional profit of 80,000. And practically what I will end up doing is I will sell this share either in the month of Feb or March, convert the notional gain of 80,000 into book gain of 80,000, and I will rebuy that share to fulfill my wish of holding this share for the long term. So my holding remains intact. But since I have booked this loss and now, since I have booked this gain, I have now 80,000 of long-term capital gains, which is within the 1 lakh threshold, which is exempt. So over the next 6 to 7 or a longer period of years that I may hold this stock, if I keep booking these gains every time they are within the threshold of 1 lakh, what I'm ensuring is that at a later point, let's say after 8 years, if I sell this stock and I happen to make a gain of 5 lakhs over the period of 8 years, I will end up paying 10% tax on the gain of 4 lakh, which is 5 lakh minus 1 lakh, which is quite a sum. On the contrary, if I keep booking these gains once every 12 months is completed, in which case I will end up not paying any tax on the gains which is below 1 lakh, and thereby still fulfill the desire of holding the stock for a longer time, still enjoy the total gains of 5 lakhs, but end up not paying any tax on it. Same ways, there is another thing that is quite often used, because what I spoke now was how to utilize your long-term gains. Let me also spare a moment to talk about how you can utilize short-term gains and losses. So I mentioned some time back that short-term losses are very useful because you can offset these losses against short-term gains as well as long-term gains. So generally what people should do is in the month of March, they should have a look at the portfolio. In case they have bought any scrips or funds which are currently in loss, but the long-term vision is intact, you want to hold it for a longer time. So one way of utilizing these losses is that you again do the same thing, sell the share or redeem the fund before the financial year ends, so that you convert this notional loss into a booked loss. And these losses can then be offset against any other gains that have been earned during that year, thereby reducing the liability. And the next day or maybe a day after that, you can again buy that share and or the fund and keep the money in that in line with the longer term. So short-term losses can be booked within the year so that it is available to be offset against any other short-term gains, or for that matter even long-term gains. This is one technique. Second strategy that can be used is keep booking long-term gains up to the threshold of 1 lakh each year, so that you don't end up paying the long-term capital gain tax at the end of a wider spectrum of say 6 or 7 years.
This is very useful, Arvind, and I'm sure that our viewers will benefit from this. Of course, a lot of them have been using the fill it, shut it, forget it strategy, having listened to advice on this channel. But I think booking intermittent profits does make sense from a tax perspective. Thanks as always for joining in and for putting things in context. It's been a pleasure speaking with you, Arvind.
Thank you, Alex, for having me here again. Back.